Okay, good. Well, hey everybody, it's 12:30 on July 22nd. For those of you who receive my hump day humor or attempts at humor every week, this is the approximate pi day. For those of you who are math challenged, and I know a bunch of my family are, pi is 3.1416. If you divide 22 by 7, you get the first bunch of digits towards pi, and that's why today is approximate pi day. It's July 22nd, 7/22. Thank you for joining us. We're here to talk about a topic that's near and dear to my heart. I've been involved in this topic virtually my entire career, kind of Nexus, where people are subject to tax. What has this Wayfair decision done to us? What can we do to remedy it? And really to answer this question, and I'm somewhat torn a little bit about how we feel about this. Should every business be subject to every tax in every jurisdiction? That's ultimately the ultimate question, and I think we have to think a little bit about that. We're going to take you through where we are now, some of the confusion associated in the states, their confusion between sales tax, income tax, gross receipts tax, the B&O tax. How do we approach things? Later on in the program, we'll talk about the expansion of it to marketplaces. So it's not just your products you're selling, it's someone who's selling products on behalf of you. That could be generally thought to be online, but there's certainly statutes that are broad enough to reach out and grab anybody who resells on your behalf. Ultimately, we'll work our way back into income taxes. We'll work our way into gross receipts taxes. And to me, one of my favorite topics I think is very important for us to discuss is what is the role of public law 8272 on a go-forward basis. So if you see this right now, this is kind of the general way we're going to go. We will not, and I repeat, not go through the Wayfair case. Okay, I for one am bored of it. I know you guys are too. We could, if people have questions about it, we can handle that offline. It would be great. Let me just step back. I jump into the topics because I get all excited about it. If you have technical issues with respect to anything that's going on, the person to contact is Hillary, who is our phenomenal marketing person who has put this together for us. Her name is all over the emails that you got, but I will give you her email address if you need to reach out to her. It's long. That's why I'm referencing you to the emails you got. HMANGIFORTE@hmblaw.com. So that's a lot. It's in your emails. I'm not going to repeat it because I'll mess it up again. For you to get, for those of you who want CLE or CPE credit, let's raise our hands. Yes. Woohoo. You must answer the very difficult questions that Dakota has put together. And there's no right or wrong answer, right, Dakota? It's really just answering them. It's kind of a polling question.
Yeah, absolutely.
Okay, so no penalty for guessing wrong. The only penalty you get is if you don't guess, you don't get credit. That's the way we mark that you guys have been intended. So there's one kind of a third of the way through, one final third of the way through, just making sure that you're staying up with us and getting it. Want to make you aware on this Zoom program, there's a chat function, so you can talk among yourselves. You can talk to us. You could direct it to all the people, all the attendees, both presenters or none of us. You can select who you want to talk to. There is a more broad one if you want to ask a question during our presentation, like why is Jordan talking so fast? Because Jordan always talks fast. There's a lot to say. I get excited about it. There's a Q&A function. Should be on the bottom of your screen. So if you move your scroll up and down, you'll be able to see the Q&A function. You just type in a question. Dakota and I both have access to that. We could take a look at that and we will respond to it. If appropriate during the presentation, certainly we will respond to it no matter what. Some of the key takeaways here. We're going to get into fiscal presence standard. What does it mean anymore? Is it even relevant anymore? Is everything economic standard? How much, how little, how long, for which taxes? We're going to get into some of the areas that I think are real bothersome right now, not only at the state level, which a number of you have been compliant with or trying to get compliant with, but the locals. One of the things that's going to come out of this pandemic, and we're seeing it right now, and I just put this as an overlay, we're not going to just deal with the states. We're going to be dealing with the locals. States are loosening up the ability of local jurisdictions to impose more and more taxes. My question then is, if they are, what are the jurisdictional standards for a local jurisdiction? Do they need to adopt Wayfair? Do they just get Wayfair because the state has it? What about local marketplace facilitator laws? What about any other type of reach do they have? Does physical presence in one part of the state mean you have physical presence in another part of the state? Does having $100,000 of sales in one state mean that you're subject to all the local jurisdictions, even if you have a single sale and it's worth $10? We're going to address those things from a Nexus, from a sales tax perspective, and then we're going to branch out and talk about it more from a gross receipts income tax perspective, because I truly believe that that's where we're going to go. We're going to see locals getting creative, being aggressive. In all frankness, they need the money. But who doesn't? Our job is to protect you guys, at least offer protections to you guys of how to combat these things. What can you do? How do you fight it? And let's discuss, what if they impose it? Let's say if they get aggressive and you've missed the deadline, you've missed it, and now a number of periods have gone on. Wayfair is 2 years old. There are people that I deal with on a daily basis who have not complied, and they say, what do we do? We'll talk about some of the ideas we have to get compliant and to move forward. Dakota and I are going to try to make this a conversation between ourselves. I think the key takeaways here is, what is physical presence? What's substantial nexus? I mean, one of the tricky things, and I've raised this to some of my friends when they've had a beer or two, because it's usually what it takes for them to want to talk state taxes with me, is if Wayfair is the standard, do physical presence matter? What if I'm a local person? I've got inventory in the state, but I don't have a storefront, but I sell online. I do have physical presence. It's not a lot, it's a little. Does that mean it doesn't matter? Wayfair doesn't matter anymore. Well, we're going to talk about, what do the statutes say? Does physical presence still matter? One of the things that we're seeing, and Dakota's going to get into this, is the changing of the guard. States adopt stuff and then they change it. And what's your responsibility to find it? And when did the changes kick in? And when do you become subject to tax? Let's say you're at 90,000 sales in December. You're not going to hit, you may hit 100 with the Christmas rush. Does that mean you have to register proactively, retroactively? And what happens next year when you start from scratch again? How do all these things kick out? We'll talk about some of the constitutional arguments that still are out there. There are some really good points. There's some equal protection things, uniformity. There's some First Amendment issues with respect to right to speech, has become very popular in the media today and in our world. So there's a couple of things that we can talk about. But key things, you know, I'm going to boil it down. Wayfair, let's start with the premise: we are all subject to tax everywhere. And now let's back up with that. States are voluntarily adopting minimum thresholds to allow small retailers, e-tailers, to not be subject to tax. Let's think about it that way. It's a different perspective, because we'll find out, as we'll talk about later on, we got one crazy state out there. I don't mean to offend anybody, but the state of Kansas is like, we don't have to do anything. Single sale, that's all you got to do. Is that right? Is that the right constitutional perspective? Is that a good statutory perspective? What if they didn't do anything? What if they just take that position? And can the locals take the same position? We'll get into that in a little bit as we move our way through here. Anything else you want to add on this slide, Dakota? Kind of just the basics?
No, I think the key takeaway here is that the U.S. Supreme Court was especially impressed by South Dakota's creation of a safe harbor. And we're going to get into that idea in a few more instances as we move through this. Creating a safe harbor, what's going to constitute a safe harbor, particularly as states move, as we think they will, into a more aggressive position. So,
okay, good.
Mind. So we've addressed the basics of Wayfair here, and those thresholds that were established. We're pretty familiar with them for the most part. A lot of states put in the exact same thresholds that South Dakota had, the 100,000 or 200 transactions. But we have this question of, how are we counting to $100,000 when it comes to sales thresholds? Are states using gross receipts, or are any looking at net receipts? Unfortunately, it's always gross receipts. We would really love it if they use net receipts. However, it's always gross receipts. Things get more interesting when we move into the question of whether you are only counting taxable receipts to get to the 100,000, or if you're looking at your total receipts. If we take Arkansas for an example, we see that Arkansas only includes taxable sales in the economic nexus threshold calculation. Now, this was kind of interesting because it wasn't immediately clear from the language of Arkansas's economic nexus statute. This had to be clarified in a legal counsel opinion issued by the state attorney general. And the state attorney general interpreted the language of the economic nexus statute to only apply to sales of taxable goods, services, or specified digital products. So this is really important. If you have hundreds of thousands of dollars of wholesale and not that much in retail, then you need to consider whether your retail sales are going to get you over that $100,000 threshold. It's important to note for Arkansas in particular that the state has not yet released regulations interpreting the economic nexus statute, so this could change when the department releases those regs. On a similar note, in Oklahoma, we see that there's what they call their small seller exemption that applies to sellers who have not made taxable sales over that threshold. So here we have two examples, states that are only looking at taxable receipts. The general rule, we're going to use Wisconsin as an example here. Wisconsin says all sales, regardless of their source or taxability, are included in the threshold calculation.
So the opposite way. And something to keep in mind here, remember, I'm of the belief all sales, all transfer of tangible personal property or enumerated service is subject to tax unless you prove that it's not. The burden is going to be on you to prove that you are not these are not taxable receipts. So for those of you that are selling primarily wholesale but do have some retail sales, make sure you get, I mean, this is a double whammy. You may not have been thinking about it because you said, I'm a wholesaler, I don't have to worry about it, but that burden's on you. You still have to collect your resale certificates, your executive certificates. You have to be prepared to show that these are not taxable sales in a state like Arkansas, where it matters for nexus purposes. The burden almost doubles because you can, if you don't have them, not only you're subject to tax because you lose your nexus protection, but you have them and they're not taxable because you don't have proof that they're not. So it's really of double importance that you document your exemption and resale certificates.
Yeah, absolutely. So in practice, we have Jordan's Fly Fishing Emporium, which sells fishing gear through the company's website and also through Amazon. So in 2020, the company will have $100,000 of sales into Arizona from its own website, plus another $150,000 of sales through Amazon. Arizona has a $150,000 sales threshold for 2020 and has a marketplace facilitator regime in place. We'll talk more about marketplace facilitators later. Is the company responsible for collecting sales tax on sales made through its own website? Here the answer is going to be yes. Arizona is a state that includes all receipts in calculating that threshold. If we were to change the facts a little bit and have $95,000 of sales into Arkansas through Jordan's Fly Fishing Emporium's website and $1 million in sales through Amazon, then we'd have a different result. So important to keep these distinctions in mind. Some sales tax thresholds to watch. Mentioned that most states are employing that $100,000 threshold, but there are a few that don't. We have those listed here. Arizona's definitely one to keep your eye on. In 2018, it started out at $200,000, was decreased to $150,000 for this year, and then we'll go down to $100,000 for 2021. Same with Tennessee. It's currently $500,000, but that's going to decrease down to $100,000 effective October 1st of this year. Just as we see states increasingly need revenue, those states that are above the $100,000 threshold, they're worth keeping an eye on just to see if that threshold's going to come down. We know that the Supreme Court, sorry?
No, go ahead.
I was saying that we know the Supreme Court approved $100,000 as being a reasonable safe harbor. And so it will be interesting to see if these states that are well above the $100,000 mark will bring themselves down to that lower threshold.
And understand that this is what I would call planned obsolescence. Inflation is a factor, right? If you look back to 1967, for example, when National Ballot House was decided, $100,000 was a huge company, big company, lots of people. $100,000 now is significant in some amounts. You know, if you had $100,000 in all 50 states, it's a $5 million business. It's a good sized business. But understand that 10 years from now, with the thresholds either staying at $100,000 or even getting smaller, they will get smaller because of inflation and rising costs. So this ultimately will make the physical presence standard or the economic nexus standard disappear over time. That's how I look at this. You know, in big states like New York, well, you know, you compare $100,000 in South Dakota versus $500,000 in New York. In New York, you've got, what's the population? 20 million people, something like that. And you've got 400 people in South Dakota. It's not a relative, it's not based upon relative size. And therefore, while New York seems to be generous, their population is huge. California is huge compared to other economies. And so there is a planned obsolescence in these things. And ultimately, I do think we're going to get down to where everybody's going to be subject to tax everywhere, but that's going to take some time and we'll see where we are after that. Just to mention Kansas, I mean, I think we're going to talk about that specifically in a little bit. Kansas is just a wacky state. It's really, for those of you who watch Days of Our Lives or any of those soap operas that we did when we were in college or now, that's Kansas. Right now, it's a soap opera. We'll get into that in just a little bit, talk about some of the specifics.
But in addition to keeping your eye on Kansas, also keep your eye on Florida and Missouri, the other two states that have not enacted economic nexus legislation. There was proposed legislation in all three of those states during the 2020 legislative session, did not pass. It's anticipated that this legislation will reappear during the 2021 legislative session.
And thank you, Paul Broman, for that reference to, is that Days of Our Lives? Yeah, so are the days, yeah, thank you very much for that. Like sands through the hourglass, these are the days of our lives. Forget it, Dakota, you know, not your generation at all.
Sorry, it's going to have to be a 2005 or later TV reference.
That's okay. And so, you know, here's just an ongoing threshold. We'll get through this relatively quickly. The 200 transaction thing is, to me, the stupidest thing in the whole world, right? Because it doesn't really get to size, it gets to frequency. At the Supreme Court argument, the conversation was about Etsy, and their average sale was $11. Let's call it $10 because it makes the math easy, right? $10 times 200 sales is $2,000 of sales into the state. Is that enough for you to be subject to tax? I think the 200 transactions is stupid. I'm seeing states remove it. We've seen them take it away, making it an and as opposed to an or. But 200 transactions as a whole is just a dumb threshold. And I really haven't run into the issue where somebody has less than $100,000 of sales but has 200 transactions where they've run into that issue. It was kind of a throw out there. It was adopted by the states just because it was part of the South Dakota legislation. I think ultimately that threshold level will go away. It's kind of a goofy thing. But and for Dakota, it doesn't matter if it's your sales through your website or the market's total sales into the states. That's the general rule, is that it's just 200 transactions no matter how they get there. Yeah. Which is just such a low number, it's ridiculous.
Yeah. The importance of this is just to keep an eye on transactions that occur through third-party websites. If you're using fulfillment by Amazon or some other method whereby you may not always know exactly how many transactions are occurring in real time, just something to keep an eye on.
Yeah. And, you know, these are states, again, my personal feeling is the transaction part of it is silly. It's more the economic side. I've seen everybody measuring by dollars. A couple of states said they have to have both. Again, I can't see you having $100,000 of sales but less than 200 transactions. So, you know, or $500,000, you're selling a couple things. It's possible, but certainly for the vast majority of you who have had this question or dealing with clients with these questions, it's usually not the question is the number of transactions. We're talking about dollars, and that's really what we focus on. But it's out there. If it works, push it. And here's that Kansas quagmire. I mean, this is really funny because they can't get legislation passed. They keep trying. They can't get the legislation passed. I don't understand what the objection is. It gets rejected by the governor. Back in 2019, the DOR said, doesn't matter. We don't need a law. We got enough statutes on our books to make everybody subject to tax. And oh, by the way, our threshold is 0. any taxable activity, any purposeful availment of the marketplace is sufficient. Their own attorney general wrote an opinion that said, can't do it, don't have the statutory authority, invalid, you can't do that. The Department of Revenue came back over the top saying, well, sue us. We're going to start enforcing this. We're going to impose it. It really has been questionable. I think everybody's got a defensible position because their own attorney general doesn't believe in the position. They've tried to pass it a couple times. To me, that's intent. The governor has rejected it. We're not going to see anything in 2020. To me, that says if they pass it, they try to pass a bill, they can't get the bill passed because either the legislature won't do it or the governor won't sign it. You know what that means? They don't have the votes. This is like a Hamilton reference. You don't have the votes. They don't have the votes to pass this. That's post 2005 for your reference, Dakota. They don't have the votes. I'm not collecting. I advise people not to collect in Kansas unless they want to, unless they have to. There's a reason to do it. Based upon the positions of the DOR, to me, it seems a little bit ridiculous. They can't do it. You know, this is also the role of politics. You've got a Republican AG, you've got Democratic in the legislature. They just can't get it done. There's other states to worry about, but this is just an interesting kind of the soap opera piece of our presentation. What about local stuff, Dakota?
The local stuff is where things get really interesting. So we have this lingering question: does acquiring economic nexus at the state level automatically result in economic nexus at the local level? This is where things get massively complex from a compliance perspective. In Illinois alone, there are 7,000 local taxing jurisdictions. If you are a nationwide business, keeping track of all those local jurisdictions becomes mind-boggling really quickly. So we're seeing that states are divided, but generally economic nexus at the state level is going to result in nexus at the local level if those local taxes are administered by the state taxing agency. So let's look at Colorado. So the Colorado Department of Revenue administers the state sales tax, as well as sales taxes that are imposed by cities, counties, and special districts. However, the Colorado remote seller rules do not apply to home rule jurisdictions in Colorado. These jurisdictions were required to pass their own economic nexus laws. So you may have economic nexus with the state of Colorado and with some home rule jurisdictions, but not all home rule jurisdictions.
So
for a second example, Jordan?
Go ahead. I was going to say, as we go through this, you know, one of the things that is most difficult about this, other than the fact that some do, some don't, you read the statute, the ordinance, and you'll take us through the next couple. We've had a couple projects, Dakota, where you can't find the ordinances. I mean, our response to most of the stuff is, well, just Google it, right? They've got to have a town access website. You got to be able to get the ordinances. Getting ordinances, up-to-date ordinances at the local level, in and of itself is a project. You know, trying to get them, you almost have to go back to the old-fashioned way, call people up, get a number. And with this pandemic, trying to find people that are back in office, that are back available, and trying to get responses is really difficult. So this is an area, and in particular in Colorado, they're really aggressive. They are very aggressive. We have a number of clients that have issues with some of the local levels on what's taxable, what's not, which district, metro district you're in, collecting the wrong rate, paying it to the wrong jurisdiction, all kinds of issues that go on with the local level. Go ahead, Dakota.
Yeah, absolutely. So to contrast Colorado, we have a state like Nebraska, where their state remote selection provides those are required to register and collect both state and local sales taxes on all sales that are delivered or sourced to a Nebraska address. So a little simpler there. Now, then we get a state like Idaho. Idaho's a kind of weird state. I have a brother who lives there. He absolutely loves it. I can't handle it. Anyway, Idaho, their state sales tax collection statute, it specifically says that remote retailers are not and shall not collect any local sales taxes. Now, let's contrast that with yet another state in New Mexico. New Mexico is a good example of why it's important to stay on top of continuing changes to rules. So currently, New Mexico doesn't require remote sellers to collect local sales taxes. They call them gross receipts taxes down there. However, as of July 1st, 2021, the the state's going to shift to a destination sourcing standard for sales of tangible personal property, and remote retailers will then be required to collect local gross receipts taxes as well. So we've got 4 states here, each one with a different approach, and each one a good example of why paying attention to the small details in the statute is vitally important.
And you hit on a concept we'll talk about Illinois as an example a little bit. I think you're going to take us through that. But you know, one of the things that Dakota mentioned is a sourcing question. And that's where you really get mucked up a bunch is it destination or is it origin? And, you know, like our home state of Illinois, we're in a hybrid world right now. It's kind of a weird situation. We'll talk a little bit about that. But if it's destination, maybe you collect it. If you don't, and, you know, the general rule was if you have nexus with the state, you have nexus with the local jurisdiction. I'm not sure that that's correct, particularly look at the state statutes because they may give the locals the ability to do that or not, or the states have, the home rule jurisdictions have their own sets of ordinances. But even on the income tax side, where if we see gross receipts sides, what are going to be the tests? It's going to spiral and become what we think a focal point of what we'll be working on over the next 5 years or so.
Absolutely. And as we continue looking into the future, looking here at what sales tax developments do we think are going to come next? States have moved remarkably quickly to reach this point. They're now facing massive revenue declines due to COVID. And just looking forward, it's not difficult to anticipate more aggressive audit action. As Jordan referenced earlier, it's now been 2 years since Wayfair was past. The Wayfair honeymoon for companies that were not compliant has arguably passed as well. On the other hand, there's also potential for amnesty programs aimed at increasing future compliance. There's a proposed program in Ohio. It's entirely possible that more states will take that route as well. We mentioned this earlier, the potentially lower thresholds as states maybe become more interested in testing out exactly what qualifies as a safe harbor. What's constitutionally appropriate? The Supreme Court left that question open in the Wayfair decision, perhaps leaving states with room for creative interpretation. Perhaps most likely seeing simple base expansion. What's taxable, particularly in the digital products and services arena. We actually publish a rolling blog called Cover Your SaaS, in which we try and tackle some of these issues. But particularly, we see base expansion as being potentially easier to implement than the digital services taxes that you may have heard of that Maryland, Nebraska, New York, and West Virginia have all proposed this year.
And that's going to be an issue. Again, we're going to get the citing, some of those other things of how you do advertising, how you do digital products, how you do these other services. And that's an issue we see on the income tax side. It's going to show its ugly head again into the sales tax side, particularly local jurisdictions. Books and records may focus it on a state. We may get that information, but at the local level, it becomes extremely difficult. The marketplace facilitators. So I'm going to just step back for a second and talk about some philosophical things about the sales tax world. And to me, philosophically, marketplace facilitators having a tax, having them an obligation makes sense. I mean, if you think about this, and I'm not picking a side whether it's good, bad, or indifferent, but since the 50s into the 60s with National LSS and then with Quill and ultimately with Wayfair, the whole point here was not that there isn't a liability. Everybody admitted there was a liability. We adopted use taxes primarily to have a complement to the sales tax to remedy that situation where you have a seller who's not located in your state. So what happens? You have a complementary use tax so that the buyer now has an obligation to self-assess and remit. The whole obligation was to collect the tax. Throughout the Quill litigation, I wasn't around for National LSS, but certainly lived through Quill. And certainly lived through Wayfair, active in Quill, just an observer at Wayfair. What we see is the emphasis that the states make is, yes, all individuals, all businesses who buy goods have an obligation to self-assess and remit use tax. But that is too hard for us to monitor, and compliance is somewhere in the 5 or 6% range, okay? So people are not complying. And there's a hole in the system. So we're going to fix that by making remote sellers, out-of-state sellers, sellers with no physical presence in the state, obligated to collect tax. We're going to let the larger entity that we can audit easily and get more money from do the collecting and remitting, so we don't have to go against Dakota and I. And of course, we pay all of our self-assessed all use taxes not collected. That's what we do. We do it correctly. But it's tough to go against me. It's tough to go against Dakota. It's easier to go after a larger seller of goods into the state. Marketplace facilitation laws are the same concept. It is difficult to go after the $100,000 seller in the state. And if you spend the resources from an audit perspective to go after every $100,000 seller into your state, and let's say that all of their sales were subject to tax and didn't collect anything, and let's say that you have a 10% rate, what you're looking at is $10,000 worth of liability. How much resources can you spend going at? How many auditors can you spend? How many audit hours can you spend? Why don't I expand that, go to marketplace facilitators who represent 1,000 of these marketplace or these remote sellers, and they all have $100,000 into the state. Make me responsible, and therefore when I find the liability, it's not $10,000, it's $1 million. That's a really good idea. Scale matters. Using our limited audit resources to go after the biggest bang for the bucks makes sense. That's from a philosophical perspective, just being consistent with the state's arguments from going away from Bellassess and Quilla to Wayfair. From a resource perspective and from a factual perspective, and I've looked at this in quite some detail, when you define a seller into the state, maybe a marketplace really is a seller. You know, let's talk about the attributes of ownership and sales. What does it mean to sell something? You kind of get into the esoteric area. Possession, control, risk of loss, collecting the money, doing credit checks. All those things are activities and are normally associated with sellers of TPP, sellers of goods and services. The marketplace, in a lot of ways that they're set up, do the exact same thing. So when you look at the requirements, the characteristics of what it means to be a marketplace facilitator or to be a seller into a state, marketplace facilitators on their own appear to have a lot of the attributes, and that makes it consistent then with the philosophical argument that we should go after the biggest sellers to make our audit job easier. So you almost have a reconciliation between the philosophical, let's go after the biggest and the largest entities to make our audit more efficient, with the factual based argument that they're actually sellers. They are selling. They possess a lot of the indices of ownership and of the sale, maybe not having title to goods, but having possession of goods, controlling goods, returning goods, taking cash, doing credit risks, replacing defective products. They do a lot of that, and therefore they have a lot of the characteristics of what the sellers are. So maybe it's just a definition of what the sellers are, and that's why this has been successful. One of the issues with marketplace facilitations is that they define them broadly. They capture everybody. And that's not necessarily the target that they're looking at. But it does make it easier to go after a $1 billion seller than it does to be a $100,000 seller. And so the laws to me make sense. I'm not saying that I'm in agreement or disagreement with them, but certainly philosophically and factually, I understand their purpose. I think it's particularly those marketplaces that actually do their own sales. They sell on their own behalf. Without naming names, there's a number of marketplaces that sell their own products, and they compete with the products that are being sold by the remote sellers that use their marketplace. If they're a seller, what's adding on a little bit more? It's just a little additional responsibility, but really the process, once you establish it, is pretty straightforward. And if I sell it and then I'm absolved from it, that's fine. It's actually having a marketplace facilitator laws make it easier for people to go into business. If you're talking about generating commerce, you could be a small seller and then not really have to worry about all of the ramifications of collection and remittance and registering for sales tax because you've got the marketplace facilitators taking care of that for you. So there is some good associated with it. You know, one of the issues we talk about is foreign sellers. This has been beaten up a lot. Foreign sellers are subject to the tax. I've looked at this from a foreign commerce clause. It's an enforcement. If you got a foreign seller and they don't collect the tax, what do? Well, California may go after your inventory. They may go after your customers. There's ways to do it, but it's a very cumbersome, tiresome troublesome process the states have to go after sellers that are not based in the U.S. or don't have assets based in the U.S. Now we move to the next slide.
Yeah, before we jump to the next
Oh,
slide, we had a question
yep.
come in asking for an
Oh.
example of a facilitator. Just
Perfect.
when we talk marketplace facilitators, we're talking about your Amazons, your eBays, your Etsy's, these large platforms through which
Well,
a third-party seller can make sales. However, we're also talking about companies that operate an in-person marketplace as well. We're not really seeing many issues with that, but we're looking more at the entities that are like Amazon or like eBay or Etsy.
right. And an easy way to test this is, say you want to buy a book on how to train dogs. You go to Google, you say, I'd like to buy a book on how to train dogs. You will see a bunch of marketplace facilitators that will answer that question, and some individual remote sellers. And that's somewhat what the states are doing. I mean, it's kind of an easy audit trail. Just do some searches on your own. But it's really, they're defined by anybody who meets certain criteria of selling it to the state. They are above the threshold, they possess the goods, they collect the money, they handle the credit checks, they invoice the people, they send out, they represent and are in contract with other remote sellers and sell their goods. Those are all definitions that you find in the state statutes of how to define a marketplace, but they're very broad. They're extremely broad. It's basically anybody who is in the act of or part of a sale into the state.
Awesome.
Yeah, we've talked a little bit about this, these things. So let's kind of just move on to the next slide. You want to take us through Illinois with our messed up state, Dakota?
Yeah, absolutely. So Illinois, as we referenced earlier, has more than 7,000 local taxing jurisdictions. So this marketplace facilitator stuff has gotten complicated real quick. The basics of the Illinois law: defining a marketplace facilitator as an entity that operates marketplace and has economic nexus with Illinois. Marketplace facilitators are deemed to be a retailer. They're required to collect and remit applicable taxes on sales made through their marketplace. Seems simple enough, so what's so complicated about this? So first of all, the original legislation created a confusing patchwork of rates. We'll illustrate this with an example. So we have a Chicago customer who wants to go out and buy a widget. Should he buy from a Chicago brick and mortar retailer, a brick and mortar retailer located elsewhere in Illinois, a remote retailer, or through a marketplace seller? It's going to be different rates associated with these. So as originally written, the Illinois law would require the remote retailers to charge the combined 10.25% state and local sales tax rate, while out-of-state sellers selling through a marketplace platform would only need to charge the 6.25% state use tax rate. Brick and mortar retailers located outside of Chicago would charge the sales tax rate applicable at their location. This is potentially as low as the 6.25% state rate. So here we have different rates for the exact same exchange of goods that produce different tax results based on who is doing the selling and where they're doing the selling from. At the end of the day, a Chicago customer is still going to end up with a widget. Now, this mess was amended to a certain extent, but this amended legislation is still treating some marketplace sellers differently. So under the amended legislation, remote retailers with economic nexus in the state that either 1, make direct sales to Illinois customers, or 2, make indirect sales to Illinois customers through unrelated marketplace facilitators are required to use, or they're required to charge, the sales tax using the destination tax rate, where the goods are ending up. However, retailers based in Illinois and retailers making sales through their own website or through an affiliated marketplace facilitator will still be required to charge tax using the origination tax rate. So we're going to illustrate this with an example. Jordan's Fly Fishing Emporium will make another appearance. So Jordan's Fly Fishing Emporium, based in Alabama, where Jordan himself is often based, has economic nexus with Illinois. Turns out that the unique lure business is surprisingly lucrative. The company sells to Chicago customers directly through its own website and through Etsy. The company will need to charge the 10.25% combined state and local tax rate applicable to Chicago for these sales. However, let's tweak this a little bit. If Jordan's Fly Fishing Emporium were to sell into Chicago through jordansoutdoorworld.com, an affiliated marketplace facilitator, then we'll only be required to charge the state 6.25% use tax. So that underlying issue was still not resolved. And as a result, this produces some lingering constitutional questions, as it advantages unaffiliated marketplace facilitators over affiliated marketplace facilitators. This potentially violates the constitutional requirement to treat out-of-state and in-state retailers similarly. We have not seen a formal challenge to this yet, but we've certainly heard it being talked about.
And this is just an example of how complex it can get when you have marketplace facilitators, retail facilitators, marketplaces that have their own selling branch, and with a citation question, which is origin versus destination. Illinois for forever has been origin-based. They've tried to change it. And let's talk about this just from a theoretical perspective. There was always a tax advantage for buying outside the state in Illinois. Because we're origin-based, even if a remote seller had an obligation to collect a tax, it was on origin-based, it would be 6.25%. If you went across the street and you bought it the same thing in Chicago, it'd be subject to over 10% tax. So if you're saving 4% by buying it outside the state, that makes sense. They tried to equalize that to benefit the businesses in Illinois. And just like a lot of legislation in our state, they messed it up. They created a confusing quagmire. And there are areas, and we're going to get into local taxes, where the state could be, the way it's written, the benefit of both use tax and sales tax and local tax separately from everybody. It's the stupidest, it's crazy. And we tried to fix the law and we weren't able to do it. But Dakota, you're going to take us through that, aren't you? Okay. And then we blame you. We're going to blame you for this law because I don't want to talk about it other than it's stupid.
Okay. Well, I don't personally want to take responsibility for the legislative quagmire. So how about we move on to local taxes?
Okay.
If we look at marketplace facilitator legislation, much like the economic nexus legislation, we're seeing that it generally applies only to state administered sales and use taxes. It does not, this legislation does not address taxes at the local level. Going back to Colorado, Colorado requires marketplace facilitators to collect state sales and use taxes and those local taxes administered by the Department of Revenue. Home rule jurisdictions are required to adopt their own marketplace facilitator ordinances if they want to require marketplace facilitators to collect city sales taxes. Currently, Inglewood, which is a suburb of Denver, appears to be the first home rule jurisdiction to propose its own marketplace facilitator ordinance. This change would redefine what it means to be engaged in business in the city of Inglewood and would require all businesses with a certain level of activity in Inglewood to collect and remit sales taxes as a marketplace facilitator. Interestingly, the Inglewood threshold requires only one delivery into the city in a 12-month period by means other than a common carrier. So if you can think of a business that makes more than one delivery into Inglewood using means other than a common carrier, this marketplace facilitator legislation could apply. It could easily simply not apply to anyone. So intriguing stuff, worth keeping an eye on.
No, and it's interesting too, is that one local jurisdiction, Colorado, has gone the extra leg to try to adopt this. There's an argument then they need to adopt this, and that any local jurisdiction trying to come after a marketplace doesn't have the statutory authority without a similar law, right? Because if one feels the need to adopt it because they're home rule, then every home rule should have to adopt it. Otherwise, you can argue under Colorado law, there is no local marketplace requirement.
Yeah, absolutely.
Do we have a polling question coming up, Dakota?
I believe we do.
Okay. So this one,
sorry.
I say this is our second one. which is fine. But it's when are you returning to the office? 4 choices. I'm already back. Labor Day, because 4th of July seemed like a dividing day. Labor Day, start of the new year for a lot of us. After Halloween, maybe in November. Sometime in 2021, we're out of here for all of 2020. Those are your choices. And if you can go ahead and vote, that would be great. Give you another couple of seconds. 10, 9, 8, 7, 6. I'm bored. What are the results?
Houston, we have liftoff. Okay, so the winner by a long shot is sometime in 2021. 42% of you will not be returning to the office until after the new year.
Wow. Okay. I mean, based upon just our own firm, that seems to be the right feeling. I think we're all looking for a cure. I just throw this out, completely unrelated. I read something that 83% of people who work in downtown Chicago take public transportation, which means that 17% of the people are driving, creating all the congestion that we have on a daily basis. If that doubled, because people want to take public transportation for the obvious health risks, 34% of people will be driving, a third of the people are driving down. I can't imagine a 2.5-hour commute to go 30 miles because that's what it would take. And so obviously there's lots of concerns out there, and it's interesting to see. We also keep talking. We're figuring this out. We'll keep moving along. Right. We didn't do the first polling question. Are we able to do that again, or we'll just ask a question at the end, maybe for a different polling question? Let's go.
Yeah. So that was just a labeling error. We'll be able to launch polling question number 2 shortly.
Great. So you guys are all good. So should we take us into, okay, there's some questions about people not being able to respond to the command. Can you get a chance? You'll be able to ask the second one. We'll give you credit. We'll talk to Hillary about it. So we will get to question 1, and we will get a response to questions 2, which should take care of that. Question is now, and this has been in struggle. What did Wayfair have to do with income tax? Really, nothing. Honestly, if you talked about it, the case law on the income, gross receipts, business and occupation tax, Nexus standards, economic Nexus has been playing out since 1993 when Jeffrey was found subject to tax in South Carolina on their licensing question. Slightly different answer because it was maybe a little bit of a sham, but that's not what the courts held then. They held that you're producing activity, you have activity producing activity, and no, that's redundant. You have business income activity in the state, you're generating revenue, royalties from the licensing of your software, and therefore you're subject to tax. This really hasn't varied. JCPenney was an aberration where they held that it wasn't, but the bank cases, being Capital One, MBNA, they basically said if you're soliciting it to the state, you got economic nexus, that's good enough for us. And that's kind of the way it's been. So for a number of years, economic nexus at the state level for income taxes has been around. Particularly on the service side. On the income tax side, and we'll talk about this in a bit, when you talk about Public Law 86-272 and its existence, what happens now, we'll talk about that because that is a law is also under attack. But states didn't, they wanted to have at least some of the same compassion they showed at the de minimis seller on the sales tax side, having a safe harbor is what Dakota referred to. They have adopted that. The MTC has talked about not just having an all-out economic nexus, everybody's subject to tax everywhere, but they have recommended and put out papers, and a lot of states have adopted the minimum thresholds, $500,000, $250,000 of sales in the state, $50,000 of property, $50,000 of payroll. They put that out as a more than de minimis activity in the state. Is there constitutional theory there? No, not really. It's just a line in the sand. In my mind, they've actually given you a benefit you may not be entitled to. They've raised the minimum standard where you have to have one of those 3 thresholds in the state. So if you're below it, you should not be subject to tax, whether you have physical presence, payroll in the state, because they've raised it to $50,000 as long as it's below that. $50,000 of property, below that, you're not subject to tax if you don't meet the sales standard in the state. But the question itself, does Wayfair affect this? In my mind, really not, other than this is a confidence thing. It's like athletes in particular, golf. I've been playing a lot of golf this summer, trying to learn how to play. A lot of it is confidence. You walk up, you see the ball, you have your club, you know you've done it before, you try to hit the club. And if you think you can't do it, you have a bad swing thought, you'll have a bad swing. You have a good thing thought, you do it. Wayfair gave the states, it empowered the states to think that they could go after everybody for everything because we've gotten rid of the physical presence standard. Well, really, they had won the war in a lot of ways other than 86-272. And as I mentioned, we'll get into that in a little bit. But other than the MCC standards, which is important, let's not diminish those. Really, if you're deriving income from activities in the state, on the income tax side, the gross receipts side, business occupation tax side, you probably do have Nexus in the state. It's been long gone. And Wayfair really doesn't have, in my mind, any more impact than it did before. It doesn't change it. We're still arguing about the same things that we did before. You know, and I have to mention this, just the ASC 740 financial accounting. I remember talking to accounting firms back in the 90s and 2000s about Nexus and reserves and what do you do? And that was Nexus and reserves were always the hardest thing. How do you justify setting up reserve for Nexus and everything? And what do you measure it by? And all the things, the rules that came out with what was FIN 48 back then. It's even more complex now because now we have this confluence of Nexus concerns, and for people of sellers of things other than tangible personal property, we've got a huge question with respect to situsing. Now, we're not going to get into all the nitty gritty about situsing of things other than tangible personal property in this presentation, but I think we have some, we did it before, it's on YouTube, on our YouTube station, we have it if you want to watch that. But not only now are you subject to tax, but the secondary question, even if I am, and let's say everybody's subject to tax everywhere, what do they get? How much of my income gets cited to a particular state? How do I cite this? So you might have Nexus per se, but you might not have any liability, which is fine. You know, we have this thing, and so from a reserve perspective, it's just getting more difficult. How do I quantify that? It is still a huge dilemma. We've worked with a number of accounting firms, worked with a bunch of clients trying to set up reasonable expectations for reserves. And I believe that's the key word, reasonable expectations. But the science of reserves, I think, is well beyond our ability to predict what's going to happen. You know, factor presence Nexus, it exists. It's a good threshold. We'll talk about 86-270 world, but really, I think they've raised the minimum threshold, but they haven't eliminated the standard, which is just having activity in the state.
Absolutely. So we're going to move fairly quickly through examples of how states have implemented these Wayfair standards in the income tax perspective. As Jordan said, it's a confidence thing. Hawaii wins the award for the most direct application of Wayfair. Just took the exact same thresholds and said, we're applying this to income tax as well. Texas already had some thresholds for the franchise tax. We're now seeing that applied in a more economic nexus perspective type way.
And remember, Texas takes the position that it is not affected by Public Law 86-272, which is bizarre because we'll get into that. I had a case back in the 90s on it, but we'll talk about the interplay of Public Law 86-272 and a state like Texas or Oregon or some of the other ones.
Yeah, absolutely. Seeing the same idea of a nexus threshold in Massachusetts. Massachusetts uses a particularly high threshold of $500,000. Interestingly, that's higher than their nexus threshold for sales taxes. So this sense that perhaps they want to treat income tax a little differently than sales taxes. Moving quickly through some of these other ones: Indiana, Utah, San Francisco. We're seeing a shift towards taxing anything where we can establish a connection. As Jordan referenced earlier, that's not that different from what the standard has always been. We're just seeing it more explicitly stated.
Yep. And just San Francisco, I read to them, I think this morning, they're trying to rethink their business taxes. There's been such an uproar They need more money. They're trying, the business community doesn't like their taxes. They're trying to rework what they're doing. So that's up for grabs. It may be a 2020 thing. It may be gone by 2021.
Yeah, certainly something worth keeping an eye on if you're in California. Two other aggressive jurisdictions, we have Pennsylvania and Philadelphia, both of which have Nexus thresholds for income tax purposes. Recently dealt with Philadelphia and was really taken aback by how aggressive the city was in pursuing enforcement for their new Nexus for income tax.
You know, these just examples were out there. We're going to see more about this in more states, to the extent they can't either kill by a thousand cuts or just decimate with a bomb, Public Law 86272. We're going to see other states going around it. You know, Oregon being the latest with the commercial activity tax, their version of the CAT. Ohio was one of the first ones. Washington business and occupation tax has been for a while. They do have some thresholds. They sometimes get adjusted for inflation, blah, blah, blah. They are ways to get around a federal protection, and that's the reason why they exist in my mind. One of the challenges that are still out there, just kind of as an overall thing, is this last one, property and payroll. Why are sales so important? They're important because they export liability. That's the sole and, to me, single reason why we've gone to a single sales factor. It is not necessarily a good indication of where you're earning your business or your business activities. The case we're all familiar with is Mormon, came out of Iowa, where they challenged Iowa's single sales factor. It was not challenged on a due process level. It was challenged on a commerce clause, and basically the Supreme Court said, close enough. You got a formula, you divvy it up. There's no duplication. If every state had the same methodology, it's all good, kind of a container rationale. But from a fairness perspective, is the location of your customer based upon some cockamamie sourcing rule the correct way to measure where a business makes money? That's a fairness question. That's a completely different question. And I think we're going to see challenges there because the property, the payroll, those still have impact. They are important. They are vital to where people earn money. And then the question is, where are those activities, and how come is it fair to just completely disregard them and just solely look at where my customer is based upon this labyrinth of citing rules that change from state to state are inconsistent? I think that's one of the future arguments that we make there.
We referenced this a little earlier. What's going on with telecommuting due to COVID-19? If we have this increased sense of having any connection to a state constituting nexus for income tax purposes, we've seen some state tax agencies that have issued formal guidance saying that if a company has an employee who's working from home due to COVID-19, that the state will not treat this as creating income tax nexus. Most state agencies have only issued informal guidance, always saying that they'll proceed on a case-by-case basis. There are a goodly number of states who simply have said nothing yet. Same goes for local taxing agencies. It's mostly deafening silence on this front. So definitely something to continue to keep an eye on, as 42% of us will not be back in the office
anytime soon.
2021, giving plenty of time to establish income tax nexus in another state potentially.
And so Dakota, let me just kind of step in here. I want to address Tom Blaze's question about economic nexus. Yes, economic nexus, I think, exists in every state. If they haven't adopted a threshold, it's a question as to whether any activities in the state. If you think about it, an income tax is a direct tax based upon how much income you're deriving using their state as a marketplace. And therefore, to me, yeah, the economic nexus standard is, are you deriving income from the state? If my threshold is $0 or $1, it's a question of fairness. It's not a commerce clause question. That's what Mormon told us. It's going to be a due process question. Is 0 too low? That's fine. We should argue about that. But for states that haven't adopted, you could point to the other states and the MTC saying, here's our minimums. If you fall below that, that's a decent argument that that's what the states feel is the constitutional level, and that a state adopting something less than that is actually out of luck and should be shot down. But that's an argument to be made. Do you want to do the last polling question, and we'll do the 86-272, wrap it up and let these people go back to work?
Yeah, absolutely. So we'll launch this second polling question now. Will there be college football this fall? Then at the very end, we will relaunch the first polling question for those of you who did not have the opportunity to vote before.
So I hope there is. I've got an aggressive tailgate schedule set up, so I hope there's college football, though I think that's one of the things that's going to be tossed. The Big Ten has said no tailgating at football games this year. At least Illinois has, my alma mater. I think it might be, but it's going to be like an 8-game schedule and maybe subject to rescheduling every week.
And as a BYU fan, I'm really looking forward to this season. There are going to be fewer opportunities to be heartbroken than in previous years.
All right, so let's wrap up the poll.
Okay. Looks like 57 of 63 have voted. Probably not. 60% of you are somewhat pessimistic. Well, makes sense.
Duke tailgate's great. Nexus, I love that. Thank you. Thank you.
I suppose it depends on what business activities you're conducting while tailgating.
Yeah. Correct. So getting to the last slide about 86-272, it still exists. It's still out there. It is the law of the land. The MTC is trying to chisel away at it. They have a draft report on it where they basically say if you have cookies in the state, they go beyond 86-272. They're expanding the list of unprotected activities. It's the death by 1,000 cuts to me is the wrong way to go, because all it does is lead to taxpayer surprise. Someone's going to get sued by the state. They're going to win or they're going to lose, but if they lose, everybody else is now responsible for 86-272. I know you have some feelings about this, Dakota. Either allow it to exist, whether it's outdated or not is a different question, or get rid of it. But to do it by 1,000 slices to me is the wrong way to do it.
Agreed.
Expand it to everybody, make it fair to everybody, or get rid of it. You know, that's a couple of the options. We've kind of gone over our time here. There's obviously ramifications with respect to throwout and throwback from a Nexus perspective. My feeling is in the world of economic Nexus, essentially, neither one of these should exist, because your business activities in the state, if you're selling it to that state and you have sales into that state, how could any state say that you're not there because you're not filing a tax return? That's up to their own state to do it. To me, it reaches beyond their borders, is unconstitutionally looking at what activities you're doing in another state to see whether you're subject to tax, because those sales still exist. We're talking about sales to a jurisdiction where you're not filing an income tax return. That's none of the home state's business. And extent that they have economic nexus, we've seen the courts say what's good for the goose is good for the gander. If they had nexus in your state based upon those activities, they have nexus in the other state regardless of that state's adoption of a lower threshold or an economic threshold. So I'm thinking that throwout and throwback should be eliminated. I know we're bouncing between Joyce and Finnegan. MTC is going back to Finnegan, which is probably theoretically the correct rule if you're a unitary state. More of this in future webinars. We're here to answer any of your questions. We appreciate you guys taking an hour out of your day to spend it with Dakota and I. Please send us our emails if with any questions. We'd be more than happy to set up a call or a text string or whatever electronic media you want, or actually the old-fashioned way, have a conversation, which I always look forward to. So on behalf of Dakota, final word.
Yeah, so I'm going to go ahead and relaunch that first poll for anyone who did not have the opportunity to vote the first time.
Okay.
So if you did not see that, go ahead and vote. If not, thank you for taking the time to join us. We appreciate it.
And again, if you have an issue with your technical things, I've seen a couple people haven't been able to vote. Please contact Hillary. Her email is all over the registration information that you received, and she'll be able to take care of that. Thank you again for your time this afternoon. Everybody stay healthy and be safe.